Good afternoon, all. Ira Epstein of Linn Associates with your agriculture update for this Monday, the 5th of August, 2019, about 1:35 p.m. Central Daylight Time. Well, you can say the sky is falling in if you look at the stock market. Look at these monstrous declines, biggest break since January. And this is obviously one thing. This is all, if you will, having to do with the trade wars that we're in. It has to do in part with the yuan, which cracked through the 7 level, could be headed up even higher. Depends how much China wants to create it. And the idea that China doesn't have as many tools as the U.S. to control itself, which is totally not true. First of all, they're not run by the democracy that we have in America. There isn't the separation of powers in the way that you would think. I am sure if President Xi tells the central bank to do something, they more than listen. Yet if our president tells the Federal Reserve to do something, not there. On the other hand, if we look at the grains, and that's what this is about, you did challenge the $4 level, and you got a nice bounce out of the corn, up 5 1/4, wheat up on the day, and even the beans up. Now, the interesting part on beans is, as you know, there was rumors, or maybe you don't know, Reuters was carrying one story where the word was that the private importers of soybeans and pork have been told by the Chinese government not to buy any more. I read other stories that were talking how much they had bought through August 2nd, so I don't know. And that's typical of how these things go. What you can see is that Brent is taking it on the chin, crude oil is taking it ours, and the differential of them is now getting into the $5 range. No longer at a $10 differential, got much narrower. You're down even in the nat gas as the weather is very, very good. So as we take a look at soybeans, we can see that last week the market finished off, as you can see, under the 18-week average, and you made, so far, you got under that. Now, that doesn't mean where we're going to close, and this is a close-only chart. I don't know where that's going to be. When we come onto a daily bar chart, this downtrend line is still very much in play, and if the market gets a rally from here, that could be an area the market ultimately wants to challenge. With today's action, this arrow that I have pointing down is wrong. They managed to pull out the settlement a quarter higher. So what I'll be doing is taking this arrow, moving it over here, and having a blue arrow pointing up. And you'll see that on each of the charts as they come forward. The interesting part is we've got this resistance line at 899 3/4. Right now, the downtrend line is around 890 on this chart. So those numbers seem to be working out in moving averages. And remember, this 18-day average will drop. The market did have a bearish crossover right through here, made the lower low and reversed up. So it has accomplished one of the goals of a bearish crossover. Bullish crossover, you're looking for a new thrust high on the move. Doesn't have to be a new low, contract low or anything. You're just looking for a high on the move or a low on the move as this one's done. In terms of Bollinger Bands, you've hit the lower Bollinger Band and been fighting against it now. So you had a couple of days under it, as you can see, got back up, fought your battle on Friday, made a new low for the move, recovered a little bit, and momentum is still embedded. Is it embedded? Takes 3 days in a row under 20. You got today, you had yesterday, and you had the day before. So you're there. So Thursday, Friday, and today. Now, if you lose that embedded reading, which happens when momentum is lost, and that would be the red line closing over 20, well, that would put into play the 18-day average, wherever it ends up, and price trying to make a run at each other. When I come over to the meal market, you can see that the meal finished the day up 250 at 297 off the Bollinger Band. The market had spent a couple of days under it. Came back on Friday, if we take a look, back under it as well. So you had 1 day under, 2 days under. And this particular day, the market finished at 350. It was over it. So you had a couple of days under. And now the market made a new low and it's trying to close higher. Unlike soybeans, it did not have a key reversal day. Like soybeans, the embedded reading is still at play. So until it loses that, you still say that the market's in a bear trend. When I come to soybean oil, the battlegrounds, the 18-day average of closes, you've been playing there for 4 days, As I said before, soybean oil is not the factor right now. It's meal and soybeans themselves. And the market's gone from a Bollinger Band top to a bottom back to the 18-day average. The trend for the moment is down. You've got lower highs, lower lows. The bias, the market closed at 27.87. That's down, and momentum is down. So until this market gets back over 28.38, I think the bears have wrestled control back in the market, which would almost make a bit of sense, by the way, before I leave that. Because you rallied here in this phase as meal and soybeans were going down. Now, if they're going to stabilize, maybe you drop the oil a little bit. In the corn market, you had been running down to the lower Bollinger Band. Remember what we talked about. When you get the 100-day average with the Bollinger Band, you got to be very careful. It's a signal that, yes, you can slide under that, but that 18-day average, that 100-day average becomes resistance on the way back up if you get a rally. You finish 414 3/4. That number's 414 3/4. So you came right back to it. The more important factor to me is that you lost the embedded reading. When that occurs, price and the 18-day average, or the closest of a moving average, come together. Did it do it today is the question I don't know, because hitting that 100-day and losing the reading satisfies me on that. If the market wants to extend, the possibility of getting to the 18-day average exists, but it's the closest of the 100 or the 18 on my rule. In the wheat market, wheat had been oversold, getting a bounce, still getting it. The market challenging and playing around 4 days in a row at that 100-day average of closes. Last week it had gotten down to the lower Bollinger Bands. So I'm going to say that I think that the 18-day average is the next resistance. If you can get this market over 503 1/4, you will negate the downtrend that's at work. I don't know if it starts an uptrend, though, because anything you do, unless you had another break early tomorrow and then a rally up, you're going to end up with lower highs and higher lows if you get through that number. In the sugar market, you let go today. Again, you've got a higher high, a lower low, a big break at one point intraday. Market did recover about 13 points off that break low, but you're not trending. You have momentum down, bias down, no trend, and you're trying to break away from the 18-day average of closes that day after day this market was hitting. Did the bears win out? Time will tell. In the coffee, still very bearish. You've got the embedded reading. You've had the pattern of lower highs, lower lows. You're riding the lower Bollinger Band. So let's assume you get a reversal in the market. The first thing I'd be looking at, do you ever lose the embedded reading, and when it happens? Number two, if it occurs, the 100-day average comes into play, which is the red line. If you exceed that, then maybe you get to the 18. Who's running this market? The bears. In the cocoa, this is called running the lower Bollinger Band, embedded reading. All the softs got very, very weak. I think it's a combination of the stronger dollar, which today finally is reversing itself as these currency wars and trade wars and everything people are talking about today seem to be unfolding. In the cotton market, lower highs, lower lows. You know, that trade war with China doesn't help cotton. The weather isn't that bad right now in the cotton regions either. The market, yeah, it's trying to get over the lower Bollinger Band, but nowhere near it. You're now 130 points under it. So during the day you tried and you couldn't succeed. Cattle market. Well, apparently, you got to worry about what's going to happen in beef now. We're coming to the end, and people don't realize that, of the barbecue season, too. You're already August 5th. The kids go back to school in about 4 weeks. Lower highs, lower lows. You reinstated the bear trend. If I take you here on Friday, you were trying to hold this number. So what you did is you came up. If you look at Friday's high, the number was 109.12. Today you got to 109.17, stalled out against the 18-day average and let loose to the downside. Yes, you're under the Bollinger Band, and you could end up trying to fight back to get within it. But because of the narrowness that it had here, I think you've caught a group of people, and you could be targeting these lower price levels that we were at before. I'd be very, very cautious if I were trying to be bullish. And the feeder cattle have broken out, again, out of a sideways action pattern. Admittedly, you have divergence. Momentum hasn't turned down with price, and this market managed to squeak back in for a higher close day over the lower Bollinger Band, which isn't bad action. It's certainly not as bearish as the fat cattle. Then we get to the hog market. Maybe this is finally it. The market had gotten down past 2 days prior to today to the Bollinger Band. You extended it and turned back up. You never did embed. I can make an argument that this break may have run its course for the near term, and a bounce, maybe short covering, is what's in store. As you can see, the stock market, as I'm putting this out, has been relentless as the market keeps climbing up, so we'll see where that carries. In any case, I'm Ira Epstein. You have yourself a good day, and I will talk to you all tomorrow.